Exchange-traded funds, or ETFs, are a great way to invest in the stock market. Funds comprise of many different stocks, sometimes hundreds, which splits your investment across all of them, meaning that you don't have to invest in each stock individually and sometimes end up having to pay hefty commission fees. Diversification is an easy way to work towards investing goals. You also outsource the effort of due diligence to a fund manager if it's an actively managed fund, or track the index over a long period of time in a passive fund. Some funds are aimed at growth and getting your investment to appreciate in value, whereas others are focused on providing you with passive income through the form of a distribution. These top 5 funds will suit both investment goals, as there are examples of growth and income funds on this list. I've also chosen a variety of regions, mainly to give you as investors global exposure in the markets. Welcome to Wise Wealth, where we dive into all things personal finance. If you like this type of content, consider subscribing and hit the bell icon to get notified of new content. Without further ado, let's get into today's video. First on the list is SPDR UK Dividend Aristocrats Fund, ticker symbol UKDV. The objective of the fund is to track the performance of certain high dividend yielding equities issued by companies from within the UK. It aims to do this by tracking the performance of the S&P UK High Yield Dividend Aristocrats Index as closely as possible. The ongoing charge for the fund is 0.3%. As an actively managed fund, the charge is slightly higher than a passive index fund, and you'll see an example of that later on to compare the difference. As an income generation fund, it currently yields 2.81% and pays dividends biannually, typically in March and September. The fund comprises of UK Dividend Aristocrats. To qualify as a Dividend Aristocrat in the UK, a company has to have increased or maintained their dividend for at least 10 consecutive years, a great feature demonstrating the reliability of these companies given the struggles many have faced in the last year. Dividend growth is a great way for long-term investing that can provide immense returns thanks to the power of compounding returns through dividend reinvestment. If you want to know more about what that means and how it works, I'll leave a link to a video I've done describing the benefits of compound interest and why you should always reinvest your dividends. The FTSE 100 is a great source of dividend stocks due to its heavy weighting towards value-oriented sectors such as oil and gas, financials, insurance, and healthcare. If you're looking for passive income over growth of your share value, this is an excellent choice. Number 2 on our list is the Baillie Gifford American Fund. The objective of the fund is to outperform the S&P 500 index by at least 1.5% per annum over rolling 5-year periods. The fund invests for growth and focuses on the US market, and its top 10 holdings include the likes of Shopify, Amazon, Tesla, Twilio, and Moderna. Although a growth fund, it doesn't only invest in technology companies, with large holdings in retailers, pharmaceuticals, and real estate. The fund has had stellar performance in the past year, currently up 54.42% from this time last year to now. The ongoing charge is slightly higher at 0.51%, but the outperformance of the index over the years has justified the fee. As well as being a growth fund, it also pays a dividend, with a yield of 0.6%. The dividend is paid annually, typically in June. But if you would rather invest in an index fund that simply tracks the index instead of an active fund trying to outperform it, the Legal & General US Index is a great choice. The objective of this fund is to provide growth by tracking the performance of the FTSE USA Index. This fund has over 600 holdings, making it one of the most diverse options available, as well as being a relatively safe option to invest in. Over the past year, the fund is up 26.58%. As an index fund, the ongoing charge is much lower, at only 0.06% per year. This is the key difference between an actively managed fund, like examples 1 and 2, and an index fund. Low-cost ETFs are a fantastic choice for investing over the long term, as the longer the time horizon becomes, the more you are able to save on fees and compound your returns further. Historically, the US has outperformed the UK in terms of total return, mostly due to its heavy tech weighting. Investing in this fund will give you exposure to household names such as Apple, Microsoft, Amazon, JP Morgan, and Johnson & Johnson. The fund also pays out a nice dividend at 1.2% currently and is paid on a biannual basis, typically in February and August. Number 4 on the list is the Baillie Gifford China Fund. Like the American fund we mentioned, this fund also focuses on growth over income, but targets Chinese companies instead. With the largest population in the world, China has experienced tremendous growth and still provides so much potential, making this fund an excellent choice for both growth and global exposure. Many institutional investors, such as BlackRock and others, have highlighted that retail investors are underinvested in China and could be missing out on a lot of upside. This fund holds some terrific companies that have high expectations for growth in the future, such as Alibaba, Tencent, and JD.com, to name a few. This has a slightly higher ongoing charge of 0.76% per year, which is typical of foreign market funds, but this has seen great performance of 34.87% gain over the past year. The objective of the fund is to outperform, after the deduction of costs, the MSCI All China Index by at least 2% per annum over rolling 5-year periods. As a growth fund, the fund only pays a low dividend of 0.1% on an annual basis, typically in June. Finally, at number 5 on the list is UDVD, the S&P US Dividend Aristocrats Fund. This is similar to the first fund on this list, but comprises of Dividend Aristocrats listed on the S&P 500 in the US, which amounts to 113 different stocks. The yield this fund provides is 2.13%, paid out quarterly in March, June, September, and December. This has proven to be stronger for growth over the UK fund, with ever-increasing share growth over time. The management fee of 0.35% is relatively low for an actively managed fund, and is a must-have for any income portfolio looking for diversification among the most reliable dividend payers in the world. So there you have it, 5 of the top ETFs to invest in 2021. If you liked this type of content, be sure to give it a like down below, and remember to subscribe to the channel for more investing and personal finance videos. I'll also leave a link to a playlist below of more top 5 videos like this, should you want to watch them. Thanks for watching, and until next time, see ya.